Hey everybody, Paulo Brands, owner of Clear to Close Brokers. I'm so glad that you are able to make it tonight. If you weren't able to make it tonight and you're watching this recording, welcome. Truth be told, I love transparency and honesty. I am pre-recording this. So when you're watching it, I'm actually here. But at home, I have 7 kids, 5 dogs, a cat, absolute craziness. And I can't guarantee you that if I was doing this live, that we wouldn't get distracted by one of the 3,000 things that could happen at my house. So what I'm going to do is I'm going to walk through the slides here. What you're going to find out is really who qualifies. We're going to walk through an example. We're also going to talk about appreciation, market forecast, interest rates. We have a lot of great things that we're going to cover. So if you have questions, you can either put them in the notes, or you can just save them. And at the end, we will open it up to Q&A. Now, if I can't answer your question, which is very possible because this program is not relatively new, it is new, I'll make sure I find those answers and I will get right back to you. So let's start with what is the Shared Appreciation Program. So essentially what it is that CalHFA is coming out and they are saying they will not gift you because it's not forgivable. You have to pay it back, up to 20% for a down payment and share of some equity appreciation that goes with the home. So there's a few things that we're gonna find out here that when you need to repay it back, but a 20% down payment is absolutely huge because it's going to allow you to get rid of mortgage insurance and all that great stuff. There's so many strategies that we can use with this program, but in a sense, that's what it is. Shared appreciation, they give you 20%. When you sell the house or refinance, you have to give back 20% plus 20% or 15%, depending on your income of the actual appreciation. So who qualifies? Each borrower must be a first-time home buyer. You must be a citizen or a national of the United States, and you have to meet the income and credit requirements for CalHFA's loans. Now, what is the definition of a first-time home buyer? So I'm going to move my screen up here. So the definition of a first-time home buyer is going to be someone that has not had ownership or interest in any principal residence, or this is key right here, or resided in a home owned by a spouse during the past 3 years. So perhaps if you got married to a spouse that owned their own house, and then you resided in that house in the past 3 years, you would be considered a non-first-time home buyer. So that's something that's very important. Owner occupancy requirements. This is only for primary residences. You must occupy the house within 60 days, but this is true with any purchase on an owner occupancy. This is also key. You can't have any co-signers. So if you can't qualify for the mortgage yourself, you can't have your parents co-sign for you, because everybody that's going to be on the loan has to reside in the income has to reside in the property. If they don't reside, you can still get a loan. You just can't use this program. Minimum credit score, it has to do, so if you have a credit score of 680 or higher, it really has to do with income. So if you are greater than the 80% of the AMI income limit, you can go as low as 660. But if it's above that limit, if you make higher income, you're going to be capped at a FICO of 680. Now, borrowers with no credit score are not permitted, and you cannot use non-traditional credit. All borrowers must meet representative credit score requirement. So we're going to use the middle score of each borrower, the lower of the middle score, to determine eligibility. All right, property types. So this is important. Single family units, single family 1-unit residence. Now, you're going to start seeing a lot of ADUs out there. We call them granny units, in-law quarters, whatever it may be. The property must be defined as a 1-unit property. So if there's 2 properties and it's defined as a 2-unit, can't do it. Multiple accessory units are not permitted, must meet investor guidelines. Don't worry about that one. And if rental income from the ADU is used to credit qualify, CalHFA will also use the gross rental income for compliance income calculation, which, by the way, that could actually hurt potentially you to qualify for this program because there are income requirements. We'll get through this. Hang on there. All right, property types. This is great news. Condos and PUDs. that are Fannie Mae eligible and meet CalHFA's Master Servicer Lakeview Servicing's guidelines. Manufactured homes are also qualified. So if you want more information on manufactured homes, just reach out. There are income limits. Now, this is important. So lenders are required to calculate income to qualify borrowers for loan approval using Fannie Mae guidelines. So let me describe what that means. So the lender is the person where the underwriter is. Now, then what happens is the lender takes the loan to CalHFA. The CalHFA needs to underwrite it too. So CalHFA will use either the lender's credit qualifying income to determine if the loan exceeds the maximum program income limit. What that means is they won't really calculate their own income. They're going to go off the lender's income. So where this could be important is, let's say, for example, let's just take bonus income. Let's be really radical. You have a $100,000 salary, and last year you received a $300,000 bonus. I wish you did. That sounds so incredible. And I know it's radical, but you'll understand where my logic is going. So that would give you last year of income of $400,000. But to use it for Fannie Mae, to use that bonus for Fannie Mae, we would need a 2-year history of it. So we would not include that bonus in our calculations. Therefore, the income we would use would be $100,000, which is great for you because now you would qualify under the income. Does that make sense? So my point is don't necessarily calculate your own income. Let us calculate your income for you to see if you truly do qualify. So last thing, income not used by the lender for credit qualifying will not be used by CalHFA, which that's really, really, really important. Okay, income limits. We're just going to go through. My main point in showing you all of the different counties in California is income is going to be limits is going to be different by county. Each county has their own limits. For example, Contra Costa, you can't make more than 282. Sacramento, 202. San Francisco, 300. Now, keep in mind, this is not household income. This is applicant income. So if you as a family make more, let's say you're in Contra Costa, as a family make more than $282,000, but individually you make less and can qualify for a mortgage, you would still qualify for this program. All right, so the terms. So when do you need to pay it back? Well, there's a couple things that could trigger that. Number one, the transfer of title. Let's say, for example, that you want to transfer your title to your kids. Once it goes into their name and out of yours, that's going to trigger a due clause, and you're going to have to pay back the shared appreciation, the down payment, and whatever it has, and whatever the appreciation that is calculated, not by you, but by CalHFA. The sale of the property, the payoff of your first loan. So if you pay this loan off in an accelerated fashion, and you pay it off in less than 30 years or at 30 years, but whenever you pay that last dollar off, that's going to trigger a due clause. So that shared appreciation is going to be due plus their original 20% down payment. Payoff of a subordinate loan principal balance, refinance of the first loan. Hang in there, you guys. There's a little asterisk there. And the formal filing and recording of a notice of a default. All right. So refinance, right? During the life of the shared appreciation loan, CalHFA will allow borrowers to refinance their first mortgage loan into a single limited cash out refinance. And that means is you cannot get cash out. You can just rewrite your first mortgage and perhaps include the fees into the loan and get yourself a better interest rate one time. That's all you can do one time. All right, homebuyer counseling. You also need to do homebuyer counseling. Not one counseling, but you need to do 2 counseling. One is going to be through CalHFA conventional loans. Well, that's a program handbook, right? There's one for them. And there's also one to be completed for CalHFA homebuyer education for shared appreciation loans. Oh, here's a little thing that you need to know, that if you do close on one of these homes, you are actually required to get a home protection coverage, so a home warranty for your house. Now, the cool thing is before I bought my first house, I always thought home warranties were kind of, I don't know, they never worked, right? It was kind of, I don't know, I just wasn't really into it. But what I found is that when they're used properly, home warranties are actually wonderful. And for how much you pay for them, the benefit, I definitely recommend getting one, even if you're not required to. But if you already use this program, you're required to get a home warranty. And the only exceptions, there's 2 exceptions, is that if you're buying new construction, and if you're not a first-time home buyer. But if you're not a first-time home buyer, you should know now you won't qualify for this loan. The home warranty must cover the following items: water heater, air conditioning, heating, oven, stove, and range. You guys, this is something that everybody should get, and I think it's wonderful that they're requiring it, because it gets really expensive if you have to right when you move in, your heater goes out, or your air conditioning. Interest rates. Now, the one thing that you need to know about interest rate as it pertains to this program, every lender is going to have the same rate. We have to go to CalHFA. It's posted daily on their website. And the difference right down here between the 6.375 or 6.125 is whether or not you qualify for their lower income. Let me see if I can move my head here. There you go. The low income rate lock. So if you meet certain criteria per county, you may qualify for a different rate. All right, let's do a quick couple examples here. Let me see if I can position my head to be out of the way. All right, let's say, for example, right now you or your friend or a family out there is pre-approved to their max at a purchase price of $500,000. Let me see if I can get a pointer here. I don't know if I can. That's all right. At $500,000. So we're going to walk our way down this column. $500,000. They're going to put 5% down, which is $25,000, and they'll have a loan amount of $475,000. Now let's go through the payment real quick. So the interest rate, we're just going to use CalHFA's interest rate today. It's 6.375. Their principal and interest is $3,015. You're going to have property taxes of $521 per month, estimated homeowners insurance $150, mortgage insurance $116. So you'll have a total payment of $3,803. Now, this is not a home buyer workshop, but what you'll find out at that home buyer workshop is you're actually not pre-approved. This is one of the biggest myths out there. You're not pre-approved to a purchase price. Rather, you're pre-approved to a payment, because what lenders look at is debt to income ratios. So in this example, the buyer, our client, cannot have a payment higher than $3,803. So if interest rates go up, that's going to be an increase on their payment, which is going to require that the principal, that their purchase price go down. Or if rates improve, they're going to have more buying power. Now, what we're going to do here is I'm going to bring in a shared appreciation little estimate for the same client, but we're going to look at a 7-year forecast. So if this person moved into the house today, kept it for 7 years, right, and then sold it, what would it look like? Now, these numbers are not perfect. We're not including real estate tax or fees. There's so much we're not including here, but I'm just trying to get the wheel spinning and get the ideas flowing. That's it. So in 7 years, and we're going to look at this appreciation report in a bit, this house will be valued at is estimated to be valued at $736,000. Your basis, or what you bought the house for, is $500,000, which means your estimated gain is going to be about $236,000. Now, in this example, you don't need to share your equity with anybody, so your final gain is going to be $236,000 in 7 years. Now, let's bring on column number 2 here. Now, for the same payment, if you were to utilize the down payment assistance program of 20%, you're going to see not only is your purchase price going to improve by $110,000. So let me just stop there and just say this. This client's buying power just went up, right? $110,000. And if we didn't even talk about cash to close, and they don't need to use their $25,000 for a down payment. Now they can, if they want to get their loan amount lower, but they get to keep the $25,000, which is absolutely huge. So the question I want to pose you is, as this program starts really gaining some momentum, that's going to put a lot of upward pressure on a lot of properties out there, and we already have limited inventory. So I'm not trying to be doom and gloom. I'm just trying to prepare you that this is going to create, or this could create, some competition out there. And so we have to make sure that we're working with the great realtors that know how to negotiate and are really working for you to see exactly what it's going to take to get your offer accepted. So in this example, to get the same payment, $3,803, using the shared appreciation program, going up $110,000. But let's fast forward 7 years and let's take a look at the shared appreciation aspect of it. So if you continue down the path, what you're going to notice so they're going to sell the house, for $897. The basis, again, that's what they bought the house for, is $609. The estimated gain is going to be about $287, but remember, they have to share 20% of that. So 20% of that $287 is going to be $57,000, which means the net gain to the client is going to be $229,000, which is very close to what they're originally going to gain. And remember, they get to keep the $25,000 down payment. There's a lot of different angles here that we're not talking about, but my main point is it's really the same thing. And this client gets to buy a house in a neighborhood, maybe that has a better school district, or just a better overall house for their family. That gives them more choices than they had before this program came out. This is absolutely wonderful example of how this can impact. We're not even mentioning people that don't have down payments, but they have decent income, and they're going to use this 20% to really get in there and get themselves a low payment with no mortgage insurance that they couldn't do before this program. All right, what else we have? Unknowns. Let's talk a little bit about the unknowns that I'm aware of. I'm sure this list will increase by the end of our conversation tonight. I really don't know when they're going to allow you to refinance, right? They may make it so there's a little asterisk there that you must meet the requirements. It may be a year, X amount of payments, loan to value. I really don't know. So that's one thing that we have to come out. Timing of the loan. In my experience, when something gains a lot of momentum like this, you're going to see a bottleneck, right? Because CalHFA has to review everything. So it's actually posted on their website, their turn times. I do expect that as we gain momentum, those turn times are going to get backed up a little bit. So if you do experience, to my real estate friends out there, if you do experience some slowdowns or, you know what I mean, some delays, I wouldn't get too worried about it. I do expect that to happen with this program, because it's going to be popular. When it will end, remember, there's 300 million. It could go in a month, 2 months, 3 months, 6 months. There's not a lot of inventory, so that may help a little bit, but just know there is an actual end date. All right, let's talk a little bit about the market. All right, so we're heading into a recession. You're going to hear a lot of stuff about whether or not it's right to buy. The crash is going to come and stuff like that. But if we take a look back at history of recessions, which it does appear, if we're not already in one, that we're definitely heading into one, interest rates, and you're going to see that the values of homes do actually very well. Let's take a look here. Let's go back to, if we go back all the way, if we look at the chart, if we go back to 1980, that recession rates went from 16% to 11.75%. 1982 rates went from 18 to 13. That's crazy, right? 1991, 11 to 8.5. 2002, 7.375 to 6.75. 2009, right? You see the actual trend here. So as we're heading into recession, we are anticipating interest rates to decline. Also, when we take a look at interest rates, as we tame inflation, in May 10th, I believe it is, could be a really strong day for us. We're going to see interest rates hovering around the 5% to 4.5%, which sounds amazing. But remember, the more buying power out there, the more buyers are out there. Our real issue is not interest rates, although it does feel that way. I feel you. It is actually supply and people wanting to sell their houses. That, my friends, is the true problem here. All right, let's go to the housing market stays strong. My head's blocking the recession, right? But if we take a look back, 1960, 1970, 74, 80, 79, 82, 90, all the recessions except for one, home values either stayed the same or increased. And the one that it didn't was 2008. But remember, the housing market caused the recession. So the decline caused the recession. The recession did not cause the decline in values. That's really important. So historically, when you look at recessions, housing and interest rates do very, very, very well. I gotta move my head for this one. Let's talk a little bit. This is fun stuff. Here's the fun stuff. Let's talk a little bit about appreciation. So I shared with you in an Excel format what an appreciation would look like for a particular property. Now, if you look here, this is for Solano County. Now, I can make these for any county, most towns. So if there's something you're interested and you want to run a scenario, let me know. I'd be happy to do that. But if you take a look in Solano County, it is estimated that the appreciation over the next 7 years is going to be 5.69%. Great wealth can be created through single-digit appreciation. Let me show you. So if you take a look at the top right, you're going to see a graph. So if you buy the house at 609, that number should ring a bell because that's the value of the property with the shared appreciation. After year 7, that house is going to be worth $897. Now, cumulative appreciation after closing costs is about $273. Here's something you'll love. We're going to take that same house and we're going to do a rent versus own. Now, remember, when you rent or when you own a property, it doesn't really clearly show this here. I'd be happy to walk you through it. A little bit too much for this. There's so many benefits in buying a home. Number one, in your monthly payment, there's a portion of it that is interest. Now, that interest, you get to write off on your taxes. Your property taxes up to $10,000. Now, it's combined. It's called SALT taxes. So it's a little bit more than I can explain here. But up to $10,000, you'll able to write off as well. Also remember, so you have interest, you can write off. Property taxes, you can partially write off. We'll just say that. Then each payment, a part of it's going towards your principal. So each month, your balance is going down. It's kind of like a forced savings account. So assuming that the value of your property stays the same or increases, if you decide to sell, you know what I mean, or rent, that money is not lost. It's built into your property. So what this is going to show you here, this is going to compare owning that home at 609, utilizing the shared equity of the 20% from CalHFA, and comparing it to what you could do to rent that payment. Now, remember, when you rent a house, the rental market is actually increasing pretty rapidly. So what you're going to see is over a 7-year difference. Now, it's not going to be the first year or two, but over a 7-year, you're going to pay $46,000 more out of your pocket to rent this home than you would be to buy it. In that same 7 years, you're going to appreciate $288,000, and your amortized gain, that's how much of the balance you pay down, is going to be about $47,000. So when you take into consideration realtor fees, and you take into consideration your appreciation, and you take into consideration, I'm missing something, the amortization that you gain, the net gain by owning this home over a 7-year period is $340,000. Now, keep in mind, this does not include what you have to give back. So after you give back your down payment and their share of the appreciation, you're looking more like $233,000, but $233,000. So in this example, and this, I think it shows clear more than any, that single digit will create great wealth. But the question you have to have, especially if you don't own a home or you want to wait it out to see what happens, and I hope you don't, especially after the slides I just showed you, is that somebody is going to gain great wealth off single digit appreciation. I certainly hope it's you. And if it's not you, it's probably going to be your landlord. All right, let's talk a little bit about interest rates. One of the biggest misconceptions this week, so we're the week of March 28th or so, the Feds increased the interest rates, and everyone thought that 30-year fixed rates were going to go up accordingly. That is not the case. Feds are short-term rates. 30-year fixed rates are actually traded on the market, mortgage-backed securities. When you go shopping for interest rates, the biggest misconception is that you shop before you're pre-approved or you get in a contract. The lender can only lock in an interest rate once you get your offer accepted on a property. So it's a property specific. And if you're to lock in on that property and you back out, you go to another property, you can't take that lock with you. Now, there's some programs out there called Shop and Lock. But if you really look at the fine print, it's not worth it at all, because either their interest rate's high or the cost is too outrageous for it. And so I just want to make sure I threw that out there and acknowledged it. But the truth is, to get you the best rate, you have to get in a contract. When you shop for interest rates is when you get in a contract, when lenders can actually commit to a rate. I'm going to tell you right now, if you talk to a lot of friends, people out there who've been through the process, one of the biggest complaints you're going to get is lack of transparency, especially when it comes to rates. We're seeing more and more of that, especially how they hide fees. It's been a little crazy over the last couple of months, but when volume gets limited, lenders get, some loan officers, some, not all, get very creative. So you have to make sure you work with somebody you trust, and that's going to give you honest advice and give you the clear answers. So there's that piece on rates. Here's a quick look at mortgage-backed securities. This is something that we monitor on a daily basis. I can tell you today's rates will not be tomorrow's rates. Every Monday, if you want, and if you're not already receiving my emails, I'd be happy to send you a rate email to show you the overall trend of where rates are going. It's very important, because even though the rates I send you may not be your specific rate, but if you see an upward trend, you won't be shocked if you get in a contract, right? I love surprises, but those are for birthday parties. They're not for buying a home. I love transparency, and I love to make sure that I can give you the most up-to-date information, and that is one way that we do that. All right. The housing market. So the Case-Shiller Home Price Index came out today, and this is the gold standard for appreciation. It showed that home prices fell by 0.5% in January on a non-seasonally adjusted basis. Now, keep in mind, as it's raining right now, especially in January, biggest storms, people aren't really looking for houses right now, and especially when interest rates have been up. So you have a double little negative right there. But when you factor in the normal softness we see that during this period, and you take out the seasonal adjustments, we're only down by about 2%. While home prices have been softening a bit, we're still up almost 4% year over year. But here's the catch. Here's the thing. I want you to hear this. From the peak of housing prices in 2022, home prices have come down by 3%, which is a far cry than what the media wants to tell you, or a housing bubble. And if you really think about this, since 2022, rates have doubled, right? Rates have doubled, and the housing prices have still held at a very strong, right? So that's why I keep saying, as rates come down, you're going to start seeing that upward pressure again. We have a supply issue, not a rate issue. I got to tell you, people were buying at 7%, the same prices they were buying at 2.5%. You give that same person that was buying at 7% an interest rate at 5%, they're going to be willing to go a lot higher. Okay, so let me know if you have any questions on that. All right, we're almost done. The home buying process, step one, you got to find a lender. You got to get pre-approved in mortgage planning. You got to get fully pre-approved. Make sure you go through all your closing costs. My friends, closing costs between lenders are very similar. There's an underwriting fee anywhere from $1,000 to $2,000, and then there's points for an interest rate. That's it. All the other fees, title fees, appraisal fees, property taxes, the huge majority of fees are going to be third-party fees, and they're going to be the same regardless of who you use. The big thing that you need to shop for is how many loans have they been doing. This is their first purchase. You probably don't want to work with them unless they're working for a team, and what their points are or origination charges are. Step two, you got to shop for a home. Make sure you're working with a great real estate agent. Now more than ever, a great realtor is key to the success of you finding a home. If you're struggling and you need a recommendation for a realtor, I work with the best realtors, and I would love to give you some names. Step three is you make an offer, right? You get your offer accepted. We lock your loan. You get a home inspection, get the appraisal, get your insurance. Step four, close on a mortgage, underwriting, closing agent, all that. It sounds so simple, doesn't it? But it kind of is, but it's kind of not. But that's the overview of the home buying process. All right, some real quick do's and don'ts. Start with the do's. Pay your bills on time. Use your credit cards as you normally would. Disclose your income and debts. We're going to find it. Lenders will find it. I promise you that. Do provide documentation of all financial information. Please don't provide 3 pages if it says 4 pages. Be upfront about your credit. Do contact if you have any questions. I almost said don't contact. That would be nice. Don't change or quit your job. Don't move. Don't apply for new credit. Do not co-sign or become a co-borrower on another loan. Don't pay off any debts, collections, or charge-offs. That is the biggest that hurts more people than not. So if you are, it makes sense to pay off a collection, that would be a good thing. Let's make sure we talk before you do that. Don't make major changes to your assets. Don't move assets because you think it's going to be easier. Talk to us, talk to your lender. And don't make any cash deposits in your bank account. Believe it or not, cash is not king. If you have cash deposits in your bank, we cannot use it. All right, lastly, frequently asked questions. Will pulling my credit hurt my credit score? It will affect your credit score from either 0 to 3 points, which is extremely minimal. You have a 30-day window. Whoops, sorry guys, where multiple lenders can pull your credit and be treated as one. Pull your credit. It's always better to know than to wonder. It's, knowing where you're at in the home buying process. Every home buyer starts with pulling their credit. If you want to be a home buyer, that's the first place I'd start. Why is my credit score different on Credit Karma? They use different systems. They use Advantage, I believe it is. 15-year versus 30-year. We don't really have those options. So I'm going to skip that question. We already went through the down payment assistance. Is it safe to buy a short sale or a foreclosure? That's totally different. I should have went through these before I did this. I'm sorry. What if the house appraises for less than a purchase price? That's a great question there. You can either renegotiate or you can make up the difference in cash. Now I'm oversimplifying this, but if it does happen, it doesn't mean it's over. Can I back out of my purchase contract? You can, assuming that you have not removed all your loan appraisal and inspection contingencies. So that's it. I'm going to wrap up. I'm going to come back live. If you have any questions, I would love to hear from you. And I hope this was helpful. All right.